Hello, this is Mike Wade, Chief Options Strategist for Tom Gentile, and welcome to this video. I'm going to talk to you today about how you can rent the world's best stocks for pennies on the dollar and double your money faster too. I say that because some of these stocks are very expensive, like this mansion here, and I'm going to teach you about how you can actually rent the mansion and not have to buy the mansion and double your money very quickly. The stock I want to talk to you about is a stock that IPO'd on May 15th, 1997 at $1.97 a share. Its market cap is $1.38 trillion, making it the third largest U.S. company behind Apple and Microsoft. It currently owns 38.7% of the e-commerce market space. Its closest competitor, Walmart, is second, a distant second, at 5.3%. And despite the coronavirus that's hammered many stocks in the U.S., it's risen 51% so far this year. Now, these impressive stats are for a company you know well, and that company is Amazon. Now, if these stats weren't impressive enough, let's take a look at a stock chart. This is the stock chart for Amazon, stock symbol AMZN, for 2020. This is the beginning, January 2nd of 2020. And notice that although there was a bit of a blip inspired by the coronavirus right back here in mid-February, when Amazon, along with the rest of the market, took a little bit of a dip, you can see right there, one of the outcomes of the COVID-19 virus was lockdowns and a curtailing of retail spending. In fact, retail spending on the whole is down so far this year, but it isn't for Amazon because Amazon is an online retailer, an e-commerce giant, and Amazon has actually risen 71% since bottoming out right back here in mid-March. In fact, it just recently set an all-time high. With online retail shopping expected to rise 18% this year, it seems quite likely to see more of this upside, particularly when you consider that the COVID-19 cases have spiked over the last couple of weeks, forcing more people back into their homes and back onto their computers to get their weekly Amazon fix. Now, there is one thing about Amazon that might be a little bit tricky, and that's the price. As I record this, Amazon is trading over $2,700 a share, $2,731 as of the time of this screenshot. So that means if you want to buy one share of stock, you've got to spend $2,731. But don't worry, I've got something for you that you're really going to like. Instead of buying Amazon, let's rent some Amazon and double our money faster too. Let's first start by looking at what it would cost us to buy 100 shares of Amazon. We could call this buying the house. If we wanted to buy the Amazon house, how much would it cost us to buy 100 shares of stock? Currently trading at $2,739 a share. If I bought 100 shares, that's going to cost me $273,900 to buy this house, 100 shares of this house. All of us at Tom's Trading Room, we all use tools, and this is a tool that I'm using. It's called a risk graph. Let's take a look at a risk graph for a long stock. And notice that the risk graph has the stock prices along the vertical axis and profit and loss along the horizontal axis, with the break-even line, this black line, delineating loss to the left and profit to the right. So what this risk graph allows me to do is essentially to translate stock price to whether I'm making money on the right side of this risk graph or if I'm losing money to the left side of this risk graph. So for example, if the stock were to rise to 3,015, which is right there, I'd make $27,600 on that move up in the stock. Conversely, if the stock were to drop to 24.65 right there, I'll position my cursor right on that intersection at 24.65 and notice that I would lose $24,650. Now, one goal you should be looking at when you're trading anything, stock, options, anything, is how far does the stock need to go for you to double your money? If I scroll on to the bottom of the risk graph, in the very lowest part of the risk graph, you'll notice that I have this column called percent to double. And notice here that for us to double our money, the stock's going to have to go up 100% to 5,478. Yes, that's exactly twice 2,739. We'll need to see the stock at 5,478 before we could even think about doubling our money. And considering that it's taken Amazon 13 years to get there, we could anticipate that it would take us a very long time to actually double our money on this trade. All right, so that's the house. That's an expensive house. We could buy it, we could hold it, we'd have to wait quite a long time, maybe 10 years or more, 13 years before we'd even see a double on this stock. But wait, there's a better way. Perhaps we could even rent the stock by buying a call option. Remember, a call option gives you the right to buy the stock at a set price by a set date and time. And you could think of these options as basically renting the stock. So we could rent Amazon in this case by buying an August 21, 2860 call. That call is going to cost us $103 per contract. And remember that one call option controls 100 shares of stock. So we multiply that number by 100, and that gives us our debit of $10,318 to control this stock for a period of 57 days. This option would expire on August the 21st, 2020. Now, of course, $10,318 is a whole lot cheaper than buying the stock at $273,900. So this is a dramatically lower cost option to actually buy a call on the stock instead of buying the stock itself. Now, back to the percent to double. If I go down to the percent to double, notice here that this option only needs the stock to go up 11.8% at expiration, which means we need the stock at 3,066 by expiration on August the 21st, and we've doubled our money on this call option. And remember, the percent to double on the long stock was 5,478. We've now reduced our cost and given ourselves a chance to double our money with the stock only moving to 3,066, which equates to an 11.8% upward movement in the stock. Yes, that's right. We double our money with an 11.8% rise in the stock. Now, it's also important to note that this long call option has no limit to the amount of money it can make. Take a look at this risk graph, and you can see all this profit over here to the right, and the risk is over to the left. So what we've done with this call option is we've dramatically reduced our risk to just over $10,000 and given ourselves a chance to make unlimited profit. So for example, using this risk graph, if the stock were to rise to $35.52 right there, I'm looking at a profit of $61,316. Now, despite all those great features, you might be looking at this entry debit of $10,318 going, hey, I don't think I have the money to do that. Maybe you don't, but don't worry, I've got an answer for you. How about if I was to tell you that we could collect some rent and offset the rent that we're paying for this particular stock? That's right. In essence, we're going to pay rent and then collect some rent by subletting the stock, reducing my cost, and maybe there's some other added benefits we'll be able to talk about. So here we go. Here's what I'm talking about. This is called a call spread. We're going to start with the original 286 call. We're going to buy one of the August 21, 2860 calls. Remember, again, those cost $103.18. Now look at this. I could sell a call option 20 strikes away, essentially collecting rent on my position, and I can bring in $95.95. That reduces my entry cost in this trade to $723. That's $7.23 per contract. If you want to break it down into rights and obligations, we have the right to buy the stock at $28.60, and we have the obligation to sell the stock to somebody else for $28.80. And if both of those two things were to transpire, we'd end up making $1,277 on our $723 purchase. That ends up being 176.63% return potential. So comparing our entry cost to the long call, we went from $10,318 all the way down to $723. That is a mere fraction, pennies on the dollar, of not only the long call spread, but also purchasing the stock itself. All right, let's take a look at the risk graph for a long call. Sometimes these are called bull call spreads. Here's our long call there. There's our short call there. Stock price is right here at the blue line. And again, we have our profit down here to the right of this line. Stock price up here. And right here at expiration, which is going to be on August the 21st, remember, if Amazon happens to be right at our short call at $28.80, we make our $1,277. All right, so that's a bull call spread risk graph. Also notice that we are capping our maximum profit, but there's a reason we want to do that. In addition to lowering our cost dramatically to $723, what we're also going to do is also lower our percent to double dramatically to $2,874. Now remember, our long call break even was $3,066. So now at expiration, the stock only needs to go up 5% by August the 21st to 2874.46, and we'll double our money with a very small move in Amazon. So in a nutshell, here are the 3 trading Amazon possibilities that I just demonstrated. First off is buying the house, which means buy the stock. Here's a risk graph for a stock. We're buying 100 shares of the stock at $27.39. Buying Amazon will double at $5,478 for a whopping cost of $273,900. Renting the house, which is essentially buying the call option, in which we're buying one of the August 21 2860 calls for $103.18. That call option doubles at $3,066. Renting the house is going to cost you $10,318. Again, that's dramatically lower than buying the house itself. And then I talked to you about how to sublet the house by actually collecting rent on the house that you're paying rent for. And that call spread was constructed by buying one August 21 2860 calls and selling one of the 2880 calls. This call spread, remember, doubles at 2874. Notice how closer that is to us than 3066. That's a dramatically better double. And the icing on the cake is this call spread will only cost us $723. Talk about pennies on the dollar of buying the stock itself. So here's our 5-step process for controlling stocks for a fraction of the cost. First step, identify high-flying stocks. Now don't worry about the cost of the stock. Higher cost is actually better. And then you want to buy a lower strike call. And I'm going to say a few strikes out of the money. Now what do I mean by out of the money? I mean strike prices that are actually higher than the current price of the stock. For example, if you're looking at a $2,000 stock, you might buy a strike price that's 2010 or 2020. Now that call option could be very expensive for a high-priced stock. So what we're going to do is add to the trade and sell a higher strike call, maybe 10 to 20 points higher than the strike price that you bought. So for example, if I bought a 1,020 call, I might sell a 1,040 call to create my bull call spread. Give yourself 2 to 3 months of time in the position, so use 60 to 90-day options. Conceivably, you could use even longer-term options if you like, depending upon how long you want to be in the trade. And then for your exits, you don't have to get too complicated. Maybe you just use a 50% loss or 100% profit and take the trade off. Now, Amazon certainly isn't the only high flyer in the market. We have stocks like Facebook, one of the FAANG stocks. Facebook just hit an all-time high a few days ago. We've got Apple. Apple's on a tear. Similar charts, as you'll notice, to Amazon, both of these stocks. These are the FAANG stocks. We've got Netflix, another FAANG stock, just hit an all-time high 3 days ago. Google, not quite as bullish as the other, just hit an all-time high right before the coronavirus, has almost recovered all of its coronavirus loss. All of these stocks are high flyers. All of them are expensive. All of them can be rented for a fraction of the cost of buying the stock. And these are great candidates for this strategy. All right, that's a wrap for this one. I hope you enjoyed the video, and I'll see you next time.